share my screen. I hope you can see my screen. Can you?
Not yet.
The black screen.
Okay, there it is. Okay.
Okay.
Now it's on.
Introduction to captives, and thank you for joining me this morning. Thomas, thank you for putting this together. We're going to go over at a fairly high level what a captive insurance company is today. And for those of you that have not looked at captive insurance, it's something that's been around probably for the last 15 to 20 years, very popular. Captives themselves have been around for 200 years, but they've gotten more vogue and they're becoming much more of a mainstream small to medium-sized business owner opportunity. And let me explain to you why. Before I launch into this, it gives a business owner the opportunity to recapture some of the premiums that they're spending for their property and casualty, and in some circumstances health, although we'll put a pin in that for today. What it is it really comes down to the choice of saying, if you're large enough, and we'll define what that is throughout the course of this morning, you can create your own insurance company, and you're really given two options. You can keep sending your premiums to Travelers or Unum or Hartford or Flo at Progressive, and if you don't have any claims, they get to keep all the profit. Or you can share in some of that profit and some of that underwriting by setting up your own insurance company. So the question is, do you want option A or option B? Not everybody's going to want to do this. This is a cultural difference because it means you as a business owner, or you as a professional talking to a business owner, they have to start realizing that there is risk. And with risk, there's some reward, but there's also some responsibility to that. And we'll go over what some of those are as we discuss this. So, introduction to captive insurance. Let me see if I can advance the slide. Hold on. All right, today's presenter is me, Tom Bacharach. I have been with RMC Group for 17 years. I've been in the industry.
No, yo voy a usar el headset. Déjame. Esto.
I'm sorry.
Mute. You could, Tom, please mute all the line if you may.
I don't know if I can mute everybody.
Okay, I think it's where everybody's muted. Yeah.
Yeah. Okay. Thank you. Again, been in the industry 37 years. RMC Group is a 50-year-old, wholly owned, holistic third-party administrator that administers captives, as we're talking about today, pension plans, 401ks, defined benefit plans, health insurance, and we're a full-service brokerage general agency for property and casualty. So for a business owner, we can handle just about any one of their concerns on an ongoing basis. And we've been doing it for 50 years. So we certainly know what we're doing. We've literally administered over 10,000 plans. So we certainly have a capability. We are not only regional, because our home office is down in Bonita Springs near you guys, but we are all over the United States, and we have offices in Europe as well. So we are local in touch, but international in scope. So we can certainly handle this. So today's discussion, again, is going to be about captives. Now, a captive insurance company, or captives as they're known, is not a product. It is the creation of an insurance company, just like any other insurance company, just like National Life or New York Life or Progressive. It is an insurance company and adheres to all those rules. And because of that, the advantage here is that you can, in working with business owners, insure their risks and the risks of their affiliates. Now, Thomas, have you ever run into a successful business owner that has more than one business?
Of course, yeah. Mhm.
Right. And so this isn't about insuring one entity. This is about insuring all of the entities with which that business owner or that business group has a relationship or an affiliation with. So the umbrella of what you can do within a captive can be very large, and the tentacles can go very far out if need be. But it's understanding that this is an insurance company, so it's not just a product, it's a highly regulated business.
Mhm.
Just like any insurance company, this is, governed by state, and has all the rules that are affiliated with. We have actually two masters in this case. We have the IRS, but we also have state regulators as well.
Mhm.
And there's also going to be times when we're going to figure out what is the best opportunity for where we're going to place this insurance company. Sometimes we're going to do it domestically in North Carolina or Utah or Virginia or one of the cituses within the United States, or we can even go offshore. St. Lucia, Nevis, Bermuda, whatever is needed based on whatever is needed by the risk or the type of hazards that we're looking at. But it's predicated by what the goals are of the client. So again, highly regulated. And then finally, it's what are the types of risks that we can put inside of this? One of the hallmarks to a captive is the fact that it's really designed to be a little bit different, to the extent that if you looked at a property and casualty, or really any policy that comes from an insurance company, it's written with very specific language. What is going to be covered? How's it going to be covered? A captive is specifically designed for that group and for that coverage so that it can take care of whatever is needed at that time. It's a little bit more flexible because it's actually being written not for everyone, but for that specific client. So it's the type of insurance can be very different. Well, let's talk a little bit about the insurances. This is a general overview of what those type of insurances can be. Oh, I'm sorry. Let me go back. General liability, those, coverages that every business is going to need. So they're going to need property coverage. Workers' comp can be placed in it, but it's a little bit more difficult because you have to have an A-rated carrier in there. But we can increase their deductibles. But if you look through this, there's lots of different things that we can do. Crime and theft, medical malpractice. I'm currently working with a very large company with physicians for medical malpractice. And they like the thought that those premiums, those $2 or $3 million worth of premiums that they're going to be putting in, can be put into an account where they're actually going to get a return on investment instead of just sending it to the insurance company and hoping that they don't have any claims. Administrative actions, business income. Now, business income, I want to spend a little bit of time on because I don't know if you guys know this, but in the last couple of years, there was this little thing called a pandemic. Insurance companies got kind of away with something on that, because when you look at business income or the business protection of income that most policies have, it's for the protection of hurricanes, water damage, crime, fire. But shouldn't a business owner be protected for their business income if the government comes in and shuts them down? Legislative change. They weren't covered for that type of business income. A captive can do that. It's flexible enough to say, what is the business income or what is the business interruption that is causing this? So there's a great deal more flexibility. And then directly underneath that, which is probably one of the biggest growing coverages, is cyber coverage. If you look at most business owners' cyber coverage, it's lumped into their general liability policy, and it's really not even written the paper worth the paper it's on. It's going to give you some type of coverages, but it's certainly not going to cover against any type of a ransomware. And it's not going to protect against any reputational risk. See, the funny thing about cyber coverage or a cyber breach, a lot of people don't realize it, is it's not only a breach against you, but if you as a business owner allow malware to go out to any of your clients that you touch, that's a contractual breach. You're in violation because you let it happen. So cyber coverage is very, very important. And then product services and kidnapping. Contract cancellation is huge. If you have any clients that have contracts, that part of their business is contracts, if more than 15 or 20% of their income comes from one specific contract, are they insuring that contract? Is it important to insure that contract against the loss of that contract? And I'll give you a real quick story. We had a crazy rodeo company. They did the kind of the half an hour in the middle of every rodeo, and they were really big out west and in Canada. And they had initially they were the Ford happy hour. Well, I don't know if you remember, but years ago the big three started to kind of fail, and Ford pulled their relationship with the rodeo company. And so they no longer had a sponsor. And it took them 2 years, and they almost went out of business because they didn't have a sponsor. They fortunately were able to get a relationship with Dodge Ram and then subsequently Ram. And they've insured that contracts against never losing it again, because that could have meant the end of their business. So it's loss of contracts, loss of key consumers, loss of key suppliers. Well, I'm going to give you an example later in this conversation about the loss of a key supplier and how, you know, it can demonstrate what type of peril a business owner might be looking at, that they're either insuring or they're self-insuring, whether they want to or not. So just some of the things. Now, when you think of property and casualty, and when you think of captive, most people go, I don't really know what a captive is. You know, captives are, you know, a small part of it. Well, in one of the later slides, you're going to see that 95% of Fortune 500 companies have a captive. What this slide is telling you is that more than 50% of the property and casualty premiums, and therefore the hazards covered in the United States right now, are in some form of a captive. What do the Fortune 500 companies know that other people don't know? And yes, it's been since 2002 that small to medium-sized business owners can do these type of things. But if more than half of that is being insured in a captive, why aren't we looking at it? And the statement that we hear, well, I wasn't aware of it, you know, it's something new, is just, it's not based on actual fact. Now, Fortune 500 usually is the gorilla in the room because they have the vast majority. I mean, you look at all that and the vast majority of the premiums are that way. But again, it's an advantage that is giving a return on investment. And so why aren't we offering that to our clients? You look at business owners, yeah, again, the two things they hate the most is insurance and taxes. Well, if we can give them something that's going to help mitigate some of their taxes, and if anybody ever tells you that a captive is a great tax play, it's not actually an accurate statement, because any expense that is associated with property and casualty or business expense under 162 of the IRS code is a tax deduction. So this isn't giving you any more or any less of a tax advantage. What it does is it shifts it, and it changes how your taxation can occur. There's an arbitrage within that, and it's an election called an 831B election. And what it says is, usually as a company, any C corporation, any S corporation, when you receive revenue, you're taxed on it, correct? Yes. In this case, in this case, it's a C corporation. So if you receive revenue in the form of premium, then you're going to be taxed at 21%, the current C corporation taxation. So imagine if you put $1 million worth of premium into this, you should be taxed $210,000. Under this small election 831B, you're not taxed on the million. You're only taxed on the growth of the million. So let's assume you put $1 million into this, and in an account you earn 5%. 5% on $1 million is 50,000. Would you rather be taxed on the million or the 50,000? That's the change in the taxes. So it's an arbitrage. So there's different taxation being offered here.
Mhm.
Does anybody have any questions before I continue? Okay. All right. So who uses a captive? Well, as I mentioned, 95% of Fortune 500 companies have some form of a captive. And for most people, they've run into captives and not necessarily realized it. Again, probably the most recognizable is Allstate, because Allstate started back in 1912 because they had Craftsman tools. Thomas, do you work with your hands? Thomas,
Yes,
do you work with your hands at all?
I do. Yeah, all the time.
Okay. Well, if you break a Craftsman tool, what happens? They replace it, right?
They're replacing. That is correct.
That's a warranty, and a warranty is nothing more than an insurance policy. So in 1912, Sears bought Craftsman tools, and they realized that they had to buy that warranty as well. And somebody brilliant said, well, instead of buying a warranty, why don't we insure it ourselves? And they created this little known company called Allstate. And so now Allstate has dwarfed, I don't even know if Sears is around anymore. But yeah, that's how Allstate started. If you've ever bought anything at Best Buy, at the end they say, do you want to use a warranty? That's their captive. They're using it. It's very, very profitable. So it's a very profitable area that makes sense to insure things that are otherwise not necessarily available in the open market. So it is available for you as well. And again, it's for smaller companies now to attain this, because usually you had to be the behemoth. Now it's available down to a much smaller size. And let's talk about that, what that means. Well, you can be too small for this because it's not going to make sense. You have to get a certain level of revenue to make it justifiable, because there's going to be a cost. See, a captive isn't too good to be true. It's too good to be free. And so there's got to be expenses that are justifiable, and there has to be enough money building up within these reserves to make sure that you've got future claims. So we're going to say that the business has got to be at least $10 million worth of gross revenue, and or, but not exclusively, $250,000 worth of property and casualty insurance spend. If you're 8 million and you're spending 400,000, we're going to look at it. If you're 10 million, but you're only spending 50,000, we're probably not going to look at it. So, you know, it's the one thing they definitely say about a captive is if you've seen one captive, you've seen one captive. You have to look at the fact pattern each and every time. And that's what we're here for, to help you with, to go through that. But the client is going to need property and casualty coverage. They're probably complaining about that. And they're going to need some risk management. And what's important about this is the risk management. When I say that, is this isn't about selling a policy. This is about going to business with a business owner, because they're going to be accepting risk. They're culturally going to have to look at this and say, okay, I'm responsible for this. But when you do that, you'd be surprised how much better their risks and their losses become when a business owner has the responsibility, and they can get a return on investment with that. Now, I say they have a need for property and casualty. Thomas, you're in Florida. Are most of your agents in Florida?
Most of them, yes.
Okay. So I'm going to go out on a limb and say, in Florida, is there any problem with renewing of property and casualty and homeowners insurance and auto insurance? Yeah, we are in a
That's a little bit of a problem.
We are in a generationally hard market. It is crazy, and insurance companies are actually getting out. Imagine as a person, now multiply that by the challenges that a business owner has. And in Florida, it's crazy what we can do within the confines of looking for those risks and then maybe giving them better alternatives within the commercial market is just absolutely phenomenal. So if you've got any business owners, it is in their best interest to have a second set of eyes look at this. It's just a matter of saying, can we look at your policy and see if you're well placed, and then see whether this makes sense, because this is a journey. This is nothing to be rushed through. So, but it's also going to be the need for risk management. A lot of this has nothing to do with insurance. And I'll give you an example. We are working with a fairly large general contractor in the Northeast right now. And one of the things I looked at was that for his electrical and his plumbing, he does a lot of subcontracting. And that subcontracting have to have, certificates of insurance and that type of, but he didn't have a hold harmless agreement, which means that if anything that sub does goes wrong, he's held liable. We went back and said, no, look, take this hold harmless. We'll give you a write-up on it. Take it to your attorney, have it drafted, and every one of your subs should be using this so that it protects you against a hold harmless. That had nothing to do with insurance. It had everything to do with legality. And so this is about making sure that the client is protected in all the ways that you can do that, not necessarily insurance. That's just part of it. It's also looking at it and saying, what is the risk mitigation? Do you have claims that are 5 and 6 years old that are sitting there just eating away at your renewal? There are certain things that should be done. Again, it's about risk management. And then this is not for that business owner that is still putting, their profits into, certificates of deposit. You've got to have somebody that's a little bit sophisticated that says, okay, I want to take that risk. I want to accept some risk because I want return on money. I want this to be able to build. I know that I can do better than what the average person does, because if you look at the way property and casualty is written, it's based on the law of large numbers. And so this says I'm better than the law of averages. So this can be a much more advantageous way of doing it. So who is this good for? Well, doctors groups, contractors, utility, lumber. We're actually going to show you an example of a lumber in a little bit later. Tech companies, any company right now that is currently has wheels, uses wheels, has relationships, or is complaining about not getting a return on investment. See, the crazy thing is when people think about insurance, you're Thomas, and I'm going to pick on you again. You're an investment person. We think of return on investment. Why are we not thinking about our risk as investment? It's a portfolio. Why aren't we getting a return on that? And why aren't we adjusting it that way? So this is a way of being able to give more efficiency to your clients.
Mm-hmm.
So let's talk a little bit about a case study. So this was interesting. This is actually a company that we've had for a while. It's a lumber yard. We talked a little bit about the differences and how the coverages can look at. Now, I'm going to show you an example of the type of coverages we offered him. But when these start, they have to do what's called a feasibility study. And a feasibility study is when the actuary comes in and actually starts assigning premiums to the risks. Because while you can say, I want to put a lot of money into a captive, there has to be actuarial proof. There has to be, insurable interest and then documentable reasons how you came up with those premiums. Yes, there's a little bit of variance so that you can overload it so that you can get more investment, sure. But it has to be based on actuarial science. And so when we did this feasibility study, one of the things that we noticed was that one of the kind of bellwether or signature lumbers that this company had was Argentinian white ash. Oh no, right? But they had an importer that they've had a relationship for about 60 years, but he would only give them more than the 30-day contract. That's just the way it had always been. So we insured the contract because it would take about 3 years or about $5 million to replace that contractor if they ever lost it. But what we also found out was that if Argentina says, you know what, I don't even like the United States, I'm sick of them, and they throw up an embargo, that's legislative change. That would have caused a problem. So we also had legislative change as well. So what you'll see in this is legislative change, reputational risk, all those type of things that you don't necessarily think about, but probably should be covering. So if we look at this, these are the type of premiums. And if you notice, there's a minimum and there's a maximum. It's because with every insurance policy, you can file the rates. This is an actuarial thing, and I won't get too wonky on you, but you know, it says with the minimum, I can guarantee that there's a 50% probability that money will be there. At the maximum, it's a 97% guarantee that will be there. You have that range of flexibility, so the business owner can actually pick and choose what they, to some extent, what they want to put into it. So if they know what they want to set aside, they can have different coverages and look at them and adjust it accordingly so that we can back into what those premiums are. Now, here's the crazy part. The more premium you put in, the more money goes into your account, the more money you're investing, the more money you get back. So a lot of times people will say, I actually want to put more money in because I'm getting return on money. So different ways to do it, but there's a great deal of flexibility. If you notice, this has directors and officers coverage. General liability, and it's DIC stands for difference of condition. Where this is interesting, and probably the most I've seen on this, is we actually had a gas and oil company that did nothing but truck gas and oil from Canada down to the lower 48. When we looked at their risk profile, what we realized was that their coverage said that they were covered while in transit. If the trucker gets out, goes to Starbucks, and there's a leak occurs, it wasn't considered in transit. So what we do at that point is say, okay, we're going to put in a general liability difference of condition to cover those gaps in coverages that are otherwise missing. And that's relatively inexpensive coverage. But it's, again, overarching. A captive is a lot more flexible in the way that they can do these coverages. Again, as I mentioned, in this case, we had political risk, regulatory change, and because it's important, especially right now with the way how litigious society is, you may also want to put in some type of reputational risk. Do you have a fund? Do you have the ability that if somebody posts something negative, that you can go after them and get that blocked and actually cover and protect your reputation? Because a brand name is only as good as the brand name. And so you want to make sure that it's covered. Those are things that we can cover. Those are more money that we can put aside so that they're more investment coming back to you. All right. Well, again, now we've covered it. We've decided what type of coverages are. That money has to go someplace. That premium has to come into this C corporation. And just like any other type of company, you're going to have to invest it. And in order to do that, there has to be some type of an investment policy. In every circumstance, an insurance company has to meet solvency requirements. Depending on where you are, whether it's offshore or onshore, it's anywhere from 20 to 40% of 1 year's premium has to be in cash or cash equivalents. Now, a lot of times people will say, well, great, I want to put money in real estate. Well, real estate is not liquid, so it doesn't get crediting. So it's not going to be good for solvency. Managed money is great because it'll give you a return. But again, it may not be as liquid as you want it to. So it might only get, like it says here, 15% crediting. So you're going to want fixed interest and kind of boring things up front, because in the first couple of years, you're setting aside reserves for future claims. You've got to build up a war chest. So what we say is, and pardon the silliness, but in the first couple of years, don't put money into Far East Asia pork belly derivatives. Put it in something relatively boring that you know it's going to be there. And usually somewhere between the 4 to 7 year mark, we kind of hit a point where we say, okay, now you can be a little bit more aggressive. And because you're going to have an investment strategy and you're going to have an investment team, we as a captive manager don't do that. That's part of what you do with the board of directors meeting. And that's where you guys come in. Usually you're the investment advisors. You have to be chosen, but that's pretty easy from a board of directors standpoint. We do that. So then you kind of look at it and say, or what are those type of things? Well, cash is king. Cash is always king. Managed accounts, you can get some. Annuities, they're actually relatively liquid. Life insurance, depending on where you use it, you can use life insurance. It's usually used for other things. It can be used as an asset, but remember, it's a high early cash value type of life insurance policy. And typically what has happened is, while you can use life insurance in the domestic places that we've been using, you have to wait 13 months because of the treaty relationship. We can still use it and it still makes sense. And it's a great opportunity because, like I said, it gets the cash value gets 100% crediting. But we have to understand where we are and what we're doing from a regulatory standpoint. And then finally, what does a captive administrator does? Well, we do the feasibility study, which is going to be that blueprint as to what this actual insurance company is going to look like. How are we going to set it up? What is the structure? That's the feasibility study. We as the captive managers are also going to be doing the accounting, the incorporation. We're going to be doing the insurance management. We're going to do the claims management. We're going to do the assessment of the assets, but we're not the asset managers. We've got to make sure that that's making sense, that you're meeting the solvency requirements, that you're meeting the reserving requirements. So there's some forensic accounting that has to occur. Again, solvency monitoring. We're going to make sure that all the regulatory stuff is taken care of. And we work very closely with regulators. And that's why, we don't choose all 38 current domiciles in the United States. We only probably have a handful, because not everybody is, just because you've got legislation doesn't mean you're great. A couple of years ago, we had a gentleman that wanted to be the first captive in the state of Montana. And we said, okay. So we spoke to the regulators and they sent us the legislation that they had written. And we said, okay, great. Looks like you copied, Vermont verbatim. And they said, well, how do you know that? And I said, well, actually, in your charter, you didn't really take out the word state of Vermont. So you want to make sure that the regulators know what they're doing and they've done this and they've got some experience. Vermont is the oldest legislation, but it has gotten very gangly and they just want the Coca-Colas and the Boeings of the world now. So we can do takeovers of existing captives. And again, part and parcel of this is not only making sure that this is set up correctly from an insurance standpoint, but are we making sure that the reinsurance that backs this is done correctly? A lot of times people will say captives are self-insurance. No, captive isn't self-insurance. There is some self-retention, but it is backed by a reinsurance relationship. And that's very important to understand. There's a 50-50 co-share. So there is sharing of risk involved with this. And then occasionally, as needed, probably once every 3 to 5 years, we're going to do some financial auditing. So that is a very quick overview of captive insurance. It is a great opportunity for those clients that are saying, I want to take more responsibility. I want a return on investment. I want alternatives that are going to give me some type of premium recapture. What questions can I answer for y'all?
Well, Tom, thank you so much for the presentation. I think that it accomplished everything that I wanted to one of the things that I wanted is for the team to be exposed to this concept of the captive insurance, and to, begin to think about, other possibilities that are out there, in adding this incredible tool to everything that we do can be of great value to some perhaps, present relationships that might be in the system right now, but also at the same time, it helps us, widen our horizon, so to speak. It is not for everyone, as you said, but there are some opportunities out there that will definitely benefit greatly from the captive concept. So thank you for for the ABC, of captive, so to speak. So
My pleasure. My pleasure. If there's anything you can do going forward, Thomas, what we'll do is I'll follow up with you a little bit later in the week.
I got a question.
Yes.
How can we capture the attention of any future client? What should I say? How should we start the conversation to get the attention of somebody that we think that might be interested in that type of business?
Elio, you coming on? I don't know. Were you able to hear, Tom? What?
Not really.
I listen to everything. You cannot hear me?
No, you coming on very, very far. Very,
Okay,
very far.
let me raise the volume. Just a second, please. Can you hear me there better?
That
Maybe
was
let's
better.
try it again.
Yes.
Okay. I just, my question is this: how can we capture the attention of someone that would think that might be interested or might be a prospect for this type of business?
Oh, okay. So first of all, do they meet that requirement, that $10 million gross revenue or $250,000 worth of property and casualty spend? If they can say yes, then really the question is, would you like to see an alternative where you can retain anywhere from 30 to 50 to 80% of those premiums that you're spending?
Okay.
If the answer is yes, then very simply get me on the phone call, or just say, okay, I will just need a copy of your current policies to look at that, because we're going to need to look at what those policies are, because that's going to be the building block for what we build the captive on. You don't necessarily want to take all of the insurance out of the traditional market at first, because it's still very effective. You're going to take those layers as you build up reserves.
Mm-hmm. Mm-hmm. Mm-hmm.
Okay.
And that is, I think that particular slide there, captivated, the main point. First of all, as I said, captive is not for everyone, but for those business owners, those companies that are doing, 10 million plus, and there's a lot of business out there. They're doing, that or more on a yearly basis, and then you capture what they are, paying for protection on the property and casualty, insurance. I mean, that could be a great opportunity because, listen, especially here in Florida, I know insurance is very, it's always, property and casualty is always tough everywhere. But if we can help a client, in a way, to capture, as you said, some of that premium for their own benefits, because the reality it is, we all pay automobile insurance, we all pay homeowners insurance. When was the last time that I got a check from my homeowners policy or my auto policy indicating, hey, Tom, you've been a faithful, a client, you never had an accident, you have paid over whatever amount of money in premium, here's a check, for good behavior. That doesn't happen.
Well, it's not necessarily, it's not just the check. It's, when was the last time you had somebody do a free comprehensive review?
Exactly.
I got another question.
Go ahead.
Yes, if we run into one of those type of people with that qualifications, would you support us and fulfilling the business?
I'm sorry, say that again.
Well, if we run into some people that are really interested in that business, would you support us to?
Oh, absolutely. That's what I do.
Yeah, exactly. That's what we got Tom over here, Elio.
Okay.
Yeah, and let me. It's your relationship. I'm just going to be. I'm there at your request. My job is to make you look good and to make sure that the client is taken care of.
Okay, fair enough.
But a lot of times, let's be honest, sometimes it's just a matter of answering their questions. You know, sometimes, okay, a client just needs to have these questions answered because they're used to somebody just coming in and, oh, here's my policy and here's renewed. No, we'll talk about what it is that you're actually trying to accomplish.
Agree. Any other questions? We're done. Thank you for taking your time.
Thomas, I appreciate your time. For everybody else that joined, I appreciate your time. And if you need me, please don't hesitate to reach out.
No, we are looking forward. This is the beginning to many more, God willing. Okay, so thank you so much. Also, again,
and what I may do is one of the gentlemen that's on here. I have two gentlemen in the Florida area that I may introduce you for the health insurance. Kyle is on there right now, but there's also another gentleman, Josh. So I think they're in the St. Petersburg area, so they're not too far from you.
okay.
All right.
Okay.
Thank you guys. Enjoy the rest of your day.
All right. Thank you. Okay. Bye-bye.
Thank you. Bye-bye.
Tomás.